Kail, come on up. Now I'm going to start us off with a speed round. Also, like McLaughlin Group, and ask some quick questions based on the Georgia tax proposals. You tell me, quick answer. Let's go casual sales. The argument that was a component we were going to charge casual sales a sales tax on those sales. The argument is 46 other states do it, and it's a fairness issue. If you have to pay sales tax when you buy a car from an automobile dealer, shouldn't you pay sales tax if you're buying it from an individual? Transactions between immediate family members were excluded. What do you think about that?
So that's I can give you the long economist answer to that. It's something I've actually debated with a couple friends on. Yes, I debate tax policy in my spare time. When you're doing this, the idea would be that you would want to tax all final sale goods and services once and only once. The question is, when it comes to, like, say, the casual sale of an automobile, you can buy a $10,000 automobile, you're taxed at 6%, you pay that, then you end up selling the car. Now the question is, have you paid 6% on something that was valued at $10,000? You are selling it for, say, $5,000. You really only enjoyed $5,000 of that, so you could, in theory, tax that $5,000 sale again at the 6%, and then rebate back that money to the original person. Unfortunately, I think that's one where kind of an ideal tax system in efficiency terms would become administratively just ridiculous. You're not going to direct back, pay the person, and kind of so forth. It'd be pretty complicated. But in terms of good tax policy, I think you really just want to go after and tax it once and only once. And so I think that you got to find the cheapest, easiest way to do that.
Yeah, I would echo what Kail said, except, in the practical side, it's awfully tough to get to, obviously, to get to that. It's the enforcement question is, reporting question is a little bit tricky, and while other states may have it, good luck getting the amount of revenue that it says it's going to raise. Yeah.
All right, automobile repairs, same thing. You said the idealistic base is for the sales tax, all goods and services at final retail sale level. The Tax Council presented several recommendations of services that were taxed in 20 or more states, looking at the mobility issue, and the legislature looked at that and said, from a compliance and administrative perspective, really the one that meets the test of being easy is the ones that are already collecting the tax, automobile repairs. Is there anything inherently wrong with taxing that? And is this something the state should be looking at?
Well, I think when it comes to that, I think the efficiency is there since the mechanism is there. However, we have to be awfully careful in a general tax reform of picking winners and losers and start singling out one service, and we're not going to take on a lot of others. And so I would say that may be one of the reasons, there's some problems, is that some picking winners and losers happened in the iterations of this. And so I think taking a broader look at, we're going to tax services or we're not, and we're going to have to make that determination. We're going to have an up and down vote instead of trying to, pick and choose and have a Swiss cheese code of what we're going to tax and what we're not. That gets a little problematic.
Yeah, I will resist making the obvious. You're not taxing a mobile entity if you're taxing auto repair, so you're not really going to be able to leave. But I would echo John's statements that I think that taxing auto repair is a good thing if it is in the big tent of overall tax reform, that you're going after other goods and services, because what's going to happen then is once you just kind of are saying, oh, we're going to go after certain entities, is it really what happens is that it's going to become a special interest group kind of free-for-all, and you're going to see good lobbying groups, lawyers, healthcare practitioners. All of this will be are going to be able to fight the reform really easily and quickly. And you're just getting taxing the poorly organized, which probably isn't ideal for tax policy.
I'll take a quick moment to add on to what I said earlier there, since Mike had to pass before me anyways. I couldn't resist the urge there. Is that generally, though, if we get to a broad enough base and you can get the rate down far enough that people are going to be better off, since they're going to be taking home more dollars on the income tax side, that the services won't be such a bad deal to pay sales tax on the services. If you can get that base broad enough, get the rate down far enough, increase your competitiveness, then overall it becomes more favorable plan. But if you're only able to get the rate down to 4.6 or something instead of getting it down further, then if you're going to pay sales taxes on services, all of a sudden that begins to add up for a lot of working folks out there.
One factor with that is that Tennessee and Florida tax automobile labor, but South Carolina and Alabama do not. We have some large cities on the border. All you have to do is cross the river, so it is somewhat mobile for some of the population. One more sales tax that was expanded and changed dramatically was telecommunications. The idea is that telecommunications has seen a lot of modernization over the last 20 years, but we're still taxing it the same way. This plan, like 7 other states, would have taxed functionally equivalent services the same way with 7% state excise tax. So I talk about the exemptions right now. That's the next question. What's your thoughts on the policy of the telecommunications tax?
Oh, you could take that hot potato.
Well, the part of it that we were looking at was the input side of it really, is that, there's been a lot of states, some more successful than others, that have been able to modernize and, bring all the telecommunication taxes into one group and, treat the various forms in a more equal manner. But if you're going to do that on the retail side, I think the main point for us was on the inputs is that you can't be taxing business inputs and expect for an elevated level on the retail side. That's just bad tax policy the way that worked out. And so going back to make sure business inputs are exempt and then broadening the base on the other areas, having a modernized system. If you do that in conjunction with each other in harmony, then all of a sudden you have a better, more efficient and more poor growth tax system. But to do it piecemeal and then leave out some very important business-to-business transactions from the exemption area, that's I think that causes some big problems.
I was joking with Jonathan because the telecommunications task force at ALEC is always hotly debated. If you ever want to have a good time, go watch those debates between everyone. It's very interesting. So I agree, and I think that when we do look at, we recently put out a paper on cell phone taxes, and you did see that these are largely a hidden form of taxation that hopefully could be brought out and simplified, which would be good for everyone. Of course, there is always the issue of defining the sales tax base in the right way and making sure that you're not penalizing businesses, because really those taxes are going to just be pushed forward onto consumers anyway. So,
all right, one more sales tax question. Obviously, the principle is we shouldn't tax business inputs. In reality, about half of our sales tax base, like nearly every other state, business inputs. So you have to pick and choose what makes the most difference. You're not going into Kinko's and buying paper. If I'm doing it for the office and you're doing it for personal use, we don't expect Kinko's or Staples to have to figure that out. But major expenses like energy and manufacturing, which are very key economically, and we've lost a lot of high-paying jobs because of that, is that makes sense. That was in this bill. Talk about that.
Sure. So I think that I was recently been working on a study on looking at competitiveness of tax competitiveness of industries that are basically easily moved, and looking at that. And so one of the things that I was talking to a lot of business leaders and site selection services, and they always kind of talk about the things that businesses most look at or most worry about. I wish taxes were always number one. They're not. But basically you get a list of about 4 or 5 consistently on there. And so one, they want to be near their marketplace, who they're trying to sell to. They want to generally have a well-educated, strong labor force with lower costs. They want to have good taxes, and then electricity prices. Basically, they want to not have to worry about a lot of that. And so and it always comes up as something that they're worried about is their utility costs. And so I think that any state that is going to tax utilities for businesses, they're kind of doing 2 things. They're raising the taxes, and they're making one of the other things that they consider a higher price as well. And so I think that exempting that is one of the major things that businesses look at. It's a major cost to business, so it obviously I think would be a very good move for the state.
Yeah, I mean, if you're looking at good bang for the buck in terms of competitiveness there, then manufacturing, electricity, agricultural electricity, all those very key sectors that depend heavily on electricity, prices, I think, is a good move in terms of, various sales tax bases and the business-to-business inputs that you could, exempt. I think this is one that's, that a lot of states are looking at. We've seen many states in the last 5 years really take a look at this because it is perpetually in the top 5 of location type ideas that companies are having, and what the factors are they look at for investing in a particular state over another.
All right, let's move over to the income tax. Reducing the corporate income tax, something our governor campaigned on and said he'd like to do, cut it to 4% from 6%. Now, we passed a single factor allocation several years ago, which limits somewhat the economic impact that it would have been by cutting the corporate income tax. Still probably a good thing. Personal income tax, I'm a little biased on the side of small business. I grew up in a small business family. So many small businesses are pass-throughs and pay on the personal income tax rate. To me, next to the sales tax exemption for energy, lowering our personal income tax rate was a huge economic driver for Georgia. And could you talk a little bit about that and the idea of going to a flat rate, getting rid of all the different brackets, and reducing some of the things like itemized deductions and exemptions and other types of deductions in code?
Yeah. Well, I mean, the overall rate on income taxes is key. The marginal rate, getting from a progressive income tax structure with the graduated rates where, you have more of a disincentive as you work your way up to a flat rate structure that does away with that disincentive, and also keeping the overall rate low, considering who your competitors are on your borders, especially. And Tennessee, 15, 20 years ago looked at income tax, and that party got voted out of office very quickly. That governor, one of the probably least finally remembered governors in Tennessee state history, and Florida's got it in their constitution. No personal income tax. Those aren't changing anytime soon. And so you got 2 zeros, one to your north, one to your south. The rate overall, 4.5 would have been a great step in the right direction. Probably needs to go lower than that as well to really become more competitive for small business, especially. That's one of the key determinants in rich states, poor states, as I mentioned. You take a look at those 9 states without income taxes. It's Texas, it's Florida, it's New Hampshire, it's South Dakota. It's states that are growing. You look at where the population went. And the census numbers came out, redistricting's all coming up. That's the buzz in all the state capitals right now. Where are the people going? Who gained the most seats in this last round of redistricting? And it was Texas. They gained 4 congressional seats in the last 10 years alone. They've created more jobs in the last 10 years than the other 49 states combined. It's been an incredible job creation engine in Texas. They did medical malpractice reform. Governor Perry said they attracted 30,000 new doctors. This is a state that's really had its eyes set on competitiveness. Not having a personal income tax and having a fairly low rate, broad-based business tax has kept really Texas in the mix. Florida gained 2 congressional seats in this last round. Now, who didn't gain seats and who lost seats is kind of interesting to look at. The states that lost seats, New York lost 2. Obviously, some of the highest income tax rates in the country. Ohio lost 2, and they have some of the highest marginal income tax rates, state and local. And then for the first time since the census of 1850, California did not gain a congressional seat in this last round of redistricting, which is fascinating to me, considering the beautiful beaches and all the amenities that California offers its residents. In fact, my co-author, Arthur Laffer, after living in California for over 50 years and building a small business, decided to leave to move to Tennessee, and he gave himself a 10% pay raise by doing so because California's personal income tax has gotten over 10%. He moved to Nashville, he loves it, he's paying 0. And that happens time and time again. The CEO of 3M recently came out and wrote in the Financial Times a few weeks ago that, he said politicians sometimes don't understand that we have a lot of competing choices when we're going to invest in some place, and tax rates are near the top of our list. And so that marginal rate, whether it's corporate or individual, is an extremely important driver. And the other kind of the counterintuitive piece of the benefits of not having personal income tax. We know the economic growth is better in the United States without. We know the population is about 2.5 times greater than the highest income tax states. The actual revenue growth over the last 10 years has been about 20 percentage points higher in the states without personal income taxes than it's been in the states with the highest income tax rates. So California, you know, they have some of the highest income tax rates in New York. California has this boom and bust problem. That's one of the problems in public finance with a graduated progressive rate income tax, whether it's corporate or individual. During the good times, people are making more money. They're going into the higher brackets, as Kail said, with Tax Freedom Day. So the revenue's coming in. They always find a way to spend it in California. And then when things fall off, there's nobody earning capital gains, no dividends, and the marginal income tax rates are not bringing in the revenue. They have this boom and bust problem. That's inherent to progressive income tax structures. Going to more of a consumption base, whether it's a flat income tax or more of a sales tax type base, is much better in terms of stability of revenue and having an overall more predictable system that you can budget off of as well. That's kind of the hidden benefit of no income taxes at the state level.
Yeah, just to echo a couple things that Jonathan said. That's right. You do see more stability when you see flat income taxes, and that stability has a number of benefits. You kind of do avoid those yo-yo budgeting issues that are always hard for states, you know, to deal with, because it's always, you know, it's always hard to know what the baseline is. You know, a lot of people thought, you know, 2007, 2006 were going to be the new baselines, and we were going to go up from there. Did not turn out to be that way. It was also good that we talked briefly, or mentioned briefly, this issue of pass-through entities and small businesses. I found it very interesting because this was one of the few points that really got bipartisan support when we were debating the extension of the Bush-era tax cuts last year. There was this issue of, well, you know, let's continue the Bush-era tax cuts for, you know, middle incomes, but let's not do it for you know, higher incomes. And then it came out that, well, you know, really what a lot of these people that are earning this income is you know, small business groups and small business individuals. I think that was really one that you know, was striking to both sides. I think it was interesting that that traction on both sides of the aisle, and really was, I think, one of the key things that kind of pushed the debate for full extension for at least 2 years is the amount of small businesses that it would tax. So I think that's also kind of an important thing that we sometimes lose sight of too. You know, just because everyone pays the individual income tax, it's used to, you know, it being on wage, you don't think of, you know, S corps and entities like that.
Listening, then I guess you all would disagree that the economist from Standard & Poor's came and told our tax council that he didn't think state tax, you know, rates made much of a difference in economic growth. I'm paraphrasing, but it's something to that effect. Last question: when you're shifting, either whether it's to a flat tax or to consumption, it's going to have a negative impact on low-income families. And what is the best way to mitigate that? In fact, I guess there are a couple of options we're familiar with. We went sort of the route of Pennsylvania and came with our own custom tax credit tables. Other states have gone with refundable earned income tax. You know, what's the best way to mitigate that impact?
Yeah, of course, this is always an issue that comes up repeatedly every time, you know, because with states, because states tend to rely on consumptive taxes, which, you know, as income rises, you tend to consume less taxable goods, and so, you know, relatively you can get, you know, less progressive or even regressive tax codes because of that. And so it is an issue that you always want to be mindful of. Now, a lot of people put a lot of faith in the progressivity of income tax codes to do that. It depends on, you know, basically everything else that's kind of going into that income tax base and the rate structure that was going into that. You know, of course, you know, if the state has, you know, the top rates kick in relatively low, say $7,000, you're probably not going to get a lot of progressivity from that. So, you know, in terms of that, I think it's up to states to determine. There's no really best practice for how you want to go about doing that, whether you want to have, you know, a large itemized deduction, or if you want to, you know, go to refundable tax route as well. There's, you know, debate by economists on which actually would be better. I think that the main thing that you want to keep in mind, though, is that you want as much transparency within this as possible. Is you want to keep the code simple enough that people can understand, you know, that what's going where and where everything's going. And so this is why a lot of times, you know, at the Tax Foundation we push, you know, stuff to be done not on the tax expenditure side, but through spending, so people can really understand what it really is. And so I think that also could be another route for some of this issue.
Yeah, I think I mean the transparency piece of it is very key when it comes to that. And some people say well, oh, we can't do a flat tax or we can't do that because then the poor would pay as much as the rich. But obviously, they forget that there's a lot of things you can tinker with on the exemption, deduction side and that type of thing, where allowing for a generous personal exemption or a standard deduction reaches that goal of kicking those people off the tax rolls, to holding them harmless on the income tax side, or then whether it's EITC for help on the sales tax bit of it. There's a lot of ways to do it. Pennsylvania has seemed to work pretty well, having the broad base, keeping their rate at it's 3.07, I think. Only Kail and I would probably know that off the top of our heads, but it's 3.07. They've had it in effect for a long time. And it actually, works fairly well there in Pennsylvania. Believe it or not, Pennsylvania's state income tax rate is actually lower than the city of Philadelphia's, and they've been able to keep it that because of the broad base, and they've been able to do it and hold the income groups fairly harmless on that side.
One thing I would give the shout out to Kelly. His paper does an excellent job talking about the effects of regressivity as well. So if you're interested, in especially how that would affect issues with federal taxes as well, are important. So.
All right, who's got a question? Over here.
Could you please discuss some of the historic arguments that were used in the beginning to exempt labor from sales tax, labor tax services? What were the reasons?
Well, traditionally the reason that you want to exempt some of those from taxation is really the issue that you basically a sales tax is meant to go after a final sale of goods and services. If it doesn't do that, then you're basically going to get what's known as tax pyramiding. Is that taxes will kind of build up as you add those factors in the cost of the product that you're producing. So. An example of this, basically what it would become no longer a sales tax, but really what's known as a gross receipts tax. So you basically have a tax that taxes everything the business does, and so then as goods move up through the cycle of production, the tax is kind of added onto those, and then which obviously adds to the cost of the goods at the end, and is distortionary also because it can interrupt the way that the incentives to form a business. So you can oftentimes move businesses around to try to avoid some of the tax issues with it. Hawaii would be an example. Jonathan and I always kind of joke about it, but Hawaii is an example of a state that has a vastly too broad of a sales tax base. It ends up basically taxing almost everything that it can with its sales tax, and so what comes across as a very nice low rate actually is taxing entirely too many industries, too many goods.
Could I just ask, roughly what time in history did sales tax
Sales tax is roughly in history. I'm not sure when they were started, but we tend to think of basically the sales tax relatively newer form of taxation, just because as states' revenues needed to grow more, it's kind of one of the newer things they've branched out onto. Now, this is also kind of the historic reason of why you see a lot of different bases within sales taxes. There's, I can't remember the name, but there's one paper, and I can try to get you a reference to it, that talks about basically the historic, why things were in the bases, because of basically when they were put into the sales tax. I can get you a reference if you'd like.
Yeah, and I think that probably some of it had to do historically with the fact that we just didn't have a practical way of collecting sales tax on services early on. And so we started with retail transactions that we actually had accounting and record keeping for. That's probably a big portion that played into it. But I wanted to echo comments on what Kail was saying. Gross receipts tax is masquerade as a broad-based, low-rate tax system, but they're a very bad tax policy, and this is based on some work that the Tax Foundation has done years ago, and several academics that have studied this issue. If you're dealing with tax reform, don't let the gross receipts tax discussion enter into the fray because it's very bad for competitiveness. It's done some very bad things in the states that have kind of tried this. It was a Depression era tax, gross receipts taxes in 1920s, 30s that really popped up. Most states eliminated them because of the competitiveness problems, lack of transparency. It's really bad for certain industries. If you're depending on high margin, low volume, high volume industries, it discriminates based on industry, picks a lot of winners and losers. So as you're going through these discussions, not all broad-based low-rate tax systems are good. We have to analyze it on what the base looks like, and gross receipts don't meet that task.
And that's all about taxing business influence. That's why it's so bad. And at least the VAT tax, you get to deduct the tax. It doesn't pyramid. You deduct the taxes you've already paid. It's not a tax on a tax on a tax. One thing unique in Georgia, I don't know if we're like the other states, is that all goods are taxed in Georgia unless explicitly exempted. All services are not taxed by a sales tax unless explicitly put in the code. And so it looks like, again, you look through and say, oh, look at all these exemptions from the special interest. Well, they're business inputs. It's appropriate that they should not be in there, but because they have to be explicitly exempted, it looks bad. And so I think that's part of the thing you have to understand. Like that.
Any comment on the insurance premium tax?
No comment. We're not very competitive in that area, I can tell you that.
Could you talk about the cost-benefit analysis of tax abatements to recruit new business into our state?
Sure. The incentives are always hard. It's a tough issue because I think that it seems like it's a great idea. You're just gonna to bring in a business and you give them a couple years startup and then they'll basically enter in and start paying taxes. And I think that what you really need to focus on is the overall structure of the tax code and what it's doing to taxes in other areas. If you're going to grant kind of abatements, for industries that come in, then you're basically going to be having to raise taxes on other existing businesses within the state, and so that's always going to be an issue that you have to face. The second part of that then is what happens once the abatements end. Are you going to be able to likely you were luring in a mobile industry that may or may not have had to make a large investment. If they didn't, once the tax abatement's over, they can shop around again and see if they can't find another state to give them incentives. So this happens. I mentioned Dell is kind of a famous example in North Carolina. Huge amounts of money were paid. Pretty much Dell closes the factory once everything's done. And people always tell you there's clawback provisions in there. That's a pretty big court battle, and we can debate on how much North Carolina's been able to get back. They spent a lot trying to get it back as well, and so I think those are some of the issues that I see is that you're giving kind of a benefit to an industry that could come in, but it could also leave, and at the same time you're going to be taxing existing businesses within your state.
Yeah, I think that inherently when it comes to abatements and certain specialized credits and exemptions, we have to be awfully careful with the picking winners and losers area of the tax reform that we talked about in terms of principles. And my home state of Michigan has kind of become a poster child for governing by tax abatement because when you have a tax system that's out of control and it's become uncompetitive, generally a lot of times they say, well, we need this type of thing even to become somewhat competitive as your state. And so I think the overall goal, ought to be make it a generally competitive tax system for everybody, so you don't have to go through and run the risk of looking at some picking winners and losers issues through the tax code. Now, obviously, the states aren't going to want to unilaterally disarm when it comes to this type of battle, but Kail raised a very good point that we see this battle play out over and over in the states, is that what happens, these abatements expire, the companies leave, all of a sudden the state is left with a good chunk of investment on the table and the jobs are gone. Michigan governed this way for years. I mean, Governor Granholm during her administration really governed by press release on cutting a new ribbon cutting, have a new ribbon cutting ceremony, announcing 100 new jobs have just been lured to the state because of her benevolence. Meanwhile, 1,000 were leaving the state because the overall tax climate was poor and costs were too high for the company playing by on the general playing field couldn't compete. And so we have to be very careful when it comes to this. And it also lends itself to charges of political favoritism based on certain industries or certain contributors. That's a very difficult situation to deal with.
We have time for about 2 more. All right, John, then we'll get Daniel.
You started off to talk about the mobility of capital, and this will really tie 2 things together. You can have some capital that's highly mobile. Google, for example, they can put something in there, they can pick up their computers and move it elsewhere. Whereas a steel mill, for example, once you've invested that money, it's there. And so it seems like to me that it's highly critical for tax stability, knowing what it's going to be. With a steel mill, because you just won't risk putting the money there. If you would please talk about the spending side of things, like Colorado's table and all of that provides a little bit more assurance on what's going to happen down the road.
Yeah, I think that the predictability/stability principle is one that we overlook, but it's a very, very important one. And whether you look at it in terms of the expectations of future tax burdens. A lot of companies aren't going to invest in California because they know every time there's a budget shortfall, they're going to come back and ask for more from the business community and from individuals, from small business. And so what institutional type of protections, I think, is a good question that we can take as states to ensure that we do have some predictability. I know Georgia has a better reputation than many states at not soaking it to business when you have a budget shortfall. However, and that may change over time, and you may want to have something institutionally. Maybe it's a Colorado-style tax and expenditure limitation that limited the growth of tax revenue by population and inflation growth. We found that it was a very, very effective tool for Colorado, and it was able to transform Colorado from a state that was middle of the pack in terms of economic growth into a state that was leading the nation in personal income growth in the 1990s. And they saw a huge pickup. They put something like $8 billion back into the private sector through tax rate reductions after they limited the rate of growth of government. That's something that actually, I was in Kansas about 2 weeks ago. The Kansas House just voted a bill out that anytime there's surplus revenue coming in, a portion, I think in the Kansas law, it's 50% be applied to reducing marginal income tax rates on personal and corporate income taxes. This is something like the Pete DuPont plan when he was governor of Delaware. It's been around for 20, 25 years, and having an institutional protection. Surplus dollars came because taxpayers are paying more. Inherently, it's not the government's money, it's the taxpayers' money. Let's give them a chunk of the first bit of the surplus. That's a pretty interesting tool. Also, the tool of supermajority requirements for tax increases has been a tool that many states have used. A little over a dozen states have supermajority requirements that adds in the extra protection and predictability when it comes to taxes. Some states like Arkansas have a hurdle as high as 75% majority in their legislature for a tax increase. And that really does add to the predictability. I think that's a very key point. I'm glad you brought it up.
Yeah, so if you're interested in Tabor and how it might have affected Georgia, the Tax Foundation actually has a little interactive thing on our website. So if you just go to taxfoundation.org/interactive, you can actually kind of see if you had implemented Tabor at certain points in your history, where you would be at. And you can play with it in different ways, kind of change it, percentage of GDP, all sorts of different growth rates that you could imagine. Now, oftentimes these tax expenditure limitations are, very good. I think that and there's a lot of them too. There's a lot of different mechanisms. One of the best resources that I can think of on that is a gentleman named Matthew Mitchell. He's at the Mercatus Institute. He's what could be called a new institutional economist, and he really has basically taken his time and has set up his research agenda to look at how different structures within how states and how they spend and how they tax and the actual mechanisms that they decide on what they're going to do affect growth rates and spending and tax within the state. So I think he'd be a good person I recommend, because he not only has looked at Tabor's, he's looked at majority rules, he's looked at line item vetoes, he's looked at line item reductions as well, which he found has been shown to be also very impactful for limiting budgets, allowing the governor not to have to go zero on something, but just cut the budget down. That was shown to have large impacts as well.
Great. I wanted to also, I saw Representative Kelvin Hill walk in. He's our ALEC chairman on the House side, so I wanted to recognize Representative Hill. Thanks for coming. And Representative Charlize Byrd, I see my friend Charlize there as well. Thank you very much for coming.
Well, in their defense too, our legislature has been very fiscally responsible over the last 10 years. We have grown about the rate of population inflation and no more, so we've done a great job at that. Daniel, you got the last question.
Okay. I think one of the problems that's kind of ran into with this issue that we just had is that the taxes on services, the Girl Scout and the pet tax and all these different things were very easy to understand for the average Georgian, but the income tax side of it with the deductions and exemptions were a little more confusing. So how do you sociologically, do you have any recommendations for convincing the average person when we do this comprehensive tax reform that it's not necessarily going to be bad for them and that it actually could be very beneficial?
I think you have to look at it in terms of overall standard of living growth, in terms of prosperity that it will bring to the state by reducing rates, becoming more competitive, the capital that will bring, the jobs that it will bring, having a real dynamic analysis of what lower rates will mean to the average Georgian, and to see what it would mean on the average taxpayer side, on the income tax side. That's a big one. Obviously, the seen and the unseen is a very interesting case study in public choice economics. Is that the problem with tax reform, why it usually doesn't happen, is that people that benefit from the code have concentrated benefits, and people are harmed by the complexity and some of the overall problems with the code have diffused costs. This is James Buchanan at George Mason University and Gordon Tullock came up with the public choice theory on this, and that's one of the real barriers that we have. That's why we don't see tax reform happen very often. It's really something nothing too much short of a miracle that we actually see fundamental tax reform take place at the federal level and at the state level. I mean, the last time we had a fundamental tax reform at the federal level was 1986. And if you've ever read the book by the Wall Street Journal reporters at the time, Showdown at Gucci Gulch, it's a very fascinating read for those of you that are interested in tax reform, all the political pieces that had to come together to make that happen. But I think focusing on the public, and what the message has to be, it has to be greater income growth for Georgians, greater job growth, greater economic competitiveness for the state, and greater population growth, that you're going to see your state match the likes of Tennessee and Florida and the other states that are certainly have it right now in terms of income taxes.
Yeah, I think it's tough. Maine tried to do this about 2 years ago. They basically tried to implement a revenue swap, taking out taxing services and then lowering their individual income tax rate. The seen, is the services that are going to be taxed. The unseen is that, when you're paying your income taxes, you're going to get a little bit less, but credits, deductions are going to move around a little bit. And it was hard for people to understand, how it was going to happen. And so I think that is tough. I think, it is always tough to try to make those convincing arguments to people that can do it. I mean, as John said, tax reform is tough. If it was easy, every state would have a great tax code. But you do have concentrated benefits and diffuse costs that are working against you. I think that in terms of that, though, I think there are some best practices maybe that could be employed a little bit. I think that just basically having we found online tools at the Tax Foundation have been very helpful for people to kind of see and use. In addition to that, regionally, Georgia's a little bit higher than your neighbors, so you can always point to that you're regionally out of line. And I think that any kind of comparison that plays off states' insecurities about their neighbors is always good. And so I think that that's always kind of something that can be used as well.
And I think I would just add to that, it's important to have an overall net tax cut, because if you have a revenue neutral plan or something, even if it's slightly their revenue increase, all of a sudden you have some winners and you have a lot of losers as well. And so it's important, if you have the revenue, to be able to buy things down to make everyone come out ahead, and make sure they know that going into the fact, because they're going to see those upfront costs that the services are going to pay more for, and they're going to see that on their bill. They're not going to see the longer term benefits, but if we know that to be the case in terms of marginal rate reductions and making Georgia more competitive, we have to make sure that at every level, people are going to be held harmless and get a net tax cut out of the deal.
So you say you shouldn't be too upset if you have a little bit of a deficit if it's a pro-growth tax reform.
Yeah.
That's exactly what we have. Well, thank you very much, Jonathan and Kail, for being with us on short notice. Thank thank you all for being here, and we will continue to fight on this issue and keep working, and we look forward to seeing you on April 19th for Sam's Table. Thank you.